Everyone, and thank you for joining us for today's webinar, Tariffs, Trade Wars, Market Gyrations, and How Australia is Impacted. For those of you who I haven't had the chance to meet as yet, my name is Jacinta Brower, and I'm a business banking executive at National Australia Bank, and it is my absolute pleasure to be your host today. Well, before we commence official proceedings, I'd like to start by acknowledging the traditional custodians of the many lands across Australia which we join from today. I pay my respects to elders past and present, and I extend that respect to all First Nations people joining today's discussion. Well, the era of a second Trump presidency has already dawned, and with increased threats of new tariffs being levied, which is likely to result in further economic confusion and uncertainties for both domestic and international investment markets. So what does this mean, and what are the implications for Australia in terms of the interest rate outlook, asset class valuations, and performance? Well, helping us to better understand the implications all this brings and to provide a comprehensive economic update, it is my great pleasure to introduce NAB's Chief Economist, Sally Auld. Sally is a widely respected economic and financial markets professional. She has a demonstrated track record in producing high-quality research within leading financial services organisations, and she enjoys building long-lasting and trusted relationships with clients. We are also extremely fortunate to have John McLeod, Senior Research Consultant from JB Weir Philanthropic Services, joining us today. John is really well known to many of you and will provide an update sharing valuable insights, paying attention to three things: the changing face of philanthropy, what does the AFR Philanthropy Top 50 data tell us about giving trends in Australia, and the latest ATO and ACNC data insights and highlights. As always, we absolutely encourage you to ask questions of our speakers using the chat function on your screen. And without further ado, it is my pleasure to introduce our first presenter, Sally Auld. Over to you, Sally.
Thanks very much, Jacinta, and good morning, everyone. It's a real pleasure to be with you this morning, and I would love to just spend a little bit of time on the global backdrop, but then also thinking about the domestic backdrop and what that means for financial markets. So we do have some slides to run through. So if we could just head to the first slide, I thought I would just start with a really brief update on Australian trade with the US. And so what we know is that we actually don't export that much to the US. Not even 5% of our goods exports go to the US. And so what that actually means is, from a macroeconomic perspective, so when we're thinking top down about the overall economy, actually a 10% tariff, which is what has been levied on Australia for most of our exports, doesn't really mean that much for us from a macro perspective. That's not to discount the impacts at a firm and industry level, but generally from a macroeconomic perspective, we are relatively well placed to weather some of the challenges around changes in US trade policy. You can see from the chart that basically our biggest export to the US is beef, and then gold is the second largest export. And so those two things really comprise the vast majority of what we send over to the US. The good news from a beef perspective is that our main competitors in that space, so countries like New Zealand, Argentina, Brazil, Chile, they all got levied with a 10% tariff as well. And so from that perspective, at least the playing field remains pretty much level. So for Australia, when we heard about the tariffs in early April, in terms of a forecasting perspective, what we did was we marked down our growth forecast for this year here in Australia by 25 basis points. So from 2.25 down to 2. And that effect really represented less of the direct impact and basically trying to account for what we think will be more of the indirect impact, which is the broader challenges around global growth, and particularly growth in Asia, if that region does get hit with some large reciprocal tariffs. So really for us, not a huge deal. And so I think what I'd like to focus on next, and if we could just go to the next slide, please, is really the bigger picture story around all of this. And so it is quite easy, I think, at the moment, with so much volatility going on around changes to trade policy, and also volatility arising from recent geopolitical events, to get really caught up in the sort of day-to-day headline noise and the volatility that comes with all of that. And so I did think it was worth maybe just spending a little bit of time with a framework that we can use to think about some of the stuff that is going on in the world at the moment. I'm sure some of you will be familiar with this because I think we have talked about it before, but it's this notion of regime change. And by regime, I basically mean a sort of 30 to 40 year period where we get really distinct, clear trends in sort of the way economies are progressing, but also the way that the politics is progressing as well. And my thesis is really that we changed regimes probably around 2016 with the election of Trump for the first time into the White House, and also with Brexit. And so the old regime, that's familiar, very familiar to most of us because it's the one that most of us grew up in. It's the one that most of us started our careers in. Was really one that's described by that list of things on the left-hand side. So it was a world in which governments, very much moved towards an ideology of free markets. And so we wanted free trade, we wanted free movement of goods and capital and labour across borders. It was the age of globalisation, the age of the multinational, and really trade was all about comparative advantage. So in Australia's instance, we gradually brought down tariffs in the late 70s, early 80s. Some industries actually didn't survive that process, but we did divert resources into the things that we have a comparative advantage in. So, for example, mining would be a great example. So we sent, minerals over to China, and in return, we imported from them manufactured goods. So that was all about comparative advantage. It was also a relatively benign period in the world's history. So it meant that governments actually had what was called a peace dividend. And really what that implies was because they weren't needing to spend so much on defence, that they could spend the money on either more productive activities or alternatively spend it on things that made life better for their population. From an investment perspective, great period to be an investor. We had a secular decline in interest rates, so a big bull market in fixed income, but that provided a huge valuation boost to other asset classes, so things like equity, things like real estate, and things like infrastructure. From a macroeconomic perspective, inflation declined over this period. The volatility of inflation fell as well. We introduced inflation targeting, and this represented what economists call the Great Moderation. So we had, on the whole, much better behaved macro variables. So inflation, less volatile, growth, less volatile. If that sounds like a nice world, it was, but that's not the world that we're in now. And so if we look at the right-hand side of that slide, what we can see is that things have shifted. And I think intuitively, all of us know this on some level, but we're now in a world where countries are looking inward and not outward. And so the driver of most economic policy decisions, most foreign policy decisions that are getting made across many countries are these ideas of economic security and national interest. So we really want to effectively care first about securing all the sorts of things that we can't produce in our own country. And the way that governments are going about that is the use of economic statecraft. And this is things like tariffs, and it's things like export controls, things like sanctions, and it also involves the return of things like industrial policy, which as economists we haven't really spoken about for a couple of decades now. We're also seeing restrictions on immigration. So, there's obviously a lot of that going on in the US. It's been a topical issue in Europe and other countries in the last decade. And this is an end of the rules-based trading system. And it's a world in which countries are looking to reindustrialize, where they're looking to remilitarize. And we also know that there's going to be a fair bit of reconstruction, hopefully going on at some point, whether that be in Ukraine or perhaps in Gaza or in other places in the world. This is also a world where public sector balance sheets are being leveraged up too. So Private sector balance sheets were the ones that leveraged up in the old regime. So households took on a lot more debt. If you look at the US banking system before the financial crisis, it took on a whole lot more debt. This era is less about private sector debt, much more about public sector debt. And from a macroeconomic perspective, a more volatile world, which is reflected in more volatility in financial markets. It's also a world where interest rates are probably going to be higher for longer. So a big repricing of the interest rate curve, and that nice valuation boost for growth assets that we saw in the old regime is actually over. So we can't rely on that when we're thinking about how we might construct portfolios. So what does this all mean? So if we just go to the next slide, I think it's worth spending a little bit of time on some of the long-term implications. And this is not an exhaustive list by any means, but something that I think it's worth paying attention to. I've only put 5 on the slide here, but they are lower long-term growth in the US. So if the US is going to become more insular, if it's going to use tariffs, there are a number of reasons why we might think that over the long run, that will lower long-term economic growth in the US. So these are stories around less investment because importing investment goods is now more expensive. It's a story around much lower population growth given restrictions on migration. It's also a story around, the research tells us that the most innovative and productive firms in the US are the ones that tend to be much more globally connected. And so if some of those global connections are broken or harder to maintain, that will probably come at a cost as well. So I think lower long-term growth in the US, which ultimately has implications for the sort of earnings growth that we can perhaps expect from the equity market over there. Another one is high inventory levels. So if we're in a world where we have, possibly disrupted supply chains, but we're also in a world where everyone is caring much more about securing the supply of key commodities or critical inputs, then all else equal, businesses, households, and governments are going to run higher levels of inventories. So this notion of just-in-time inventory management is probably no longer relevant in this regime. And the problem with running higher inventories is that they impose a cost on governments and businesses. So for business, usually those inventories need to be financed. But also inventory management is difficult. It can be too easy to get sort of too much or too little of the right or the wrong good or at the right or the wrong time. And so inventory management can pose a business risk to profitability, and it can also create a bit of macro volatility. So higher inventory levels are the new normal, as is higher macro volatility. A couple of other things in terms of markets. The world in this regime is going to want to hold fewer US assets, and that's going to be reflected in a weaker US dollar in coming years, and we've already seen that dynamic at play just in the last couple of months. But investors globally are going to rethink what is the optimal allocation to US assets. And the context for this is really interesting, just simply because the world has largely been very overweight US assets for the last 15 years. So most investors, we think globally, are going to hold fewer of them, and they're going to have less US dollars. And so therefore, we think the US dollar is likely to be in a structural bearish trend for the next couple of years. We should see higher inflation as a consequence of all of this. So if we have a less efficient organization of production and supply, I think all else equal, that takes out that disinflationary tailwind that we benefited from for a number of decades as globalization took place. And that will be the new normal, I think, for many central banks. And the final point is that in this world, commodity demand will rise. And that's largely a consequence of some of those themes around reindustrialization, remilitarization. But I think it's also a consequence of a world where when governments are wanting to secure, particular key commodities or critical inputs, that means that they're going to want to hold more hard commodities and more soft commodities. And so that's actually a positive, I think, for the commodity complex overall. But it's also a positive for commodity currencies, and particularly countries like Australia, where we are obviously a big exporter of commodities. If we can just go to the next slide, please. So that's generally the sort of big picture world, and I think that has implications for the way that we put portfolios together. In particular, there are just a couple that I would highlight. One is a pretty obvious one, which is in this world, we're going to want to hold more inflation protection in our portfolios, and we can do that through exposure to certain types of infrastructure. We can do that through certain types of exposure in the fixed income market, like inflation-linked bonds. So that's the first implication. The second one is we're going to want to hold less US dollar exposure in our portfolio. So that's going to be quite a big change from the way that we've constructed portfolios in the last decade. And I think as a consequence of this story around commodities, we're going to want to hold more commodity exposure, more Aussie dollar exposure, and more energy exposure. So they're probably three areas of portfolios that we would look to build up in coming years. A couple of other things, we're going to want to hold, I think, in general, less growth assets in our portfolios. So we're used to being really overweight equities, in particular in portfolios. I think we're going to want to hold less of those. And that's partly a story around what earnings growth might look like in some markets, but it's also a story around that structurally higher term structure of interest rates. And what that means is that we should, on average, be able to get more superior or more attractive risk-adjusted returns in fixed income. So there's some of the themes that I think drop out of the way we're thinking about regime change and some of the longer-term implications. So just in the last couple of minutes, I just wanted to spend a little bit of time on Australia, on what's going on. I did mention before that we have lowered our sights a little bit on growth here in Australia in the current year. Part of that was a global story. Part of it's also a domestic story. And a couple of things that I think worth noting locally. One is just a story around margin compression. And so what we see in our own business survey that we run every month, and what we also hear consistently from many of our clients, both large and small businesses, is that they are feeling margins are under pressure. And you can see that in the data. So in both those charts on this slide, different ways of showing the same thing. On the left, we're looking at operating margins in the listed sector, so for companies in the ASX 200. On the right-hand side, the red line just actually looks at that profitability index that's in our own NAB business survey. And what I've done here is just map those two series against various measures of labour demand. On the left, we're looking at hours worked, and on the right, we're looking at the 12-month change in the unemployment rate. And so what the charts tell us is that when margins are expanding and firms are feeling positive, that's actually a great thing for the labour market. We want more people and we want them to work more hours. When margins compress, you get the reverse outcome. And you can see quite clearly on the chart on the left that aggregate hours worked have come down a lot, quite sharply in the last couple of years as margins have come under pressure. What's interesting in the chart on the right is that the red and the black line have diverged a little bit. And so I guess what that is telling us is that at the moment, if you think about the unemployment rate, that's much more to do with headcount rather than hours worked. And what that chart is telling us is that so far, firms have managed that margin compression by reducing hours worked, not necessarily by reducing headcount. But I think what that tells you also is that that can only go on for so long. And in the chart on the right, it's not often that the red and the black line diverge. And so we're watching that pretty closely as a really key dynamic for this economy over the next little while. If we could just go to the next slide. I think the one good thing that's happened here, and we've heard this from the Reserve Bank, who are now far more comfortable about the inflation outlook than they have been at any point in the last couple of years, is that inflation has come down. And the chart here shows you goods and services inflation. Red line is services inflation. The black line is goods inflation. And the dotted lines are our 2 to 3% target band. And you can see that these things move around and sort of beat to their own drum a little bit. But importantly, the big game changer over the last little while has been that ongoing disinflation in services. That was the real bugbear for the Reserve Bank, I think, for at least sort of 6 to 12 months. And they are now far more comfortable that that red line is approaching the 3% level, that they now have a situation where they're more confident that inflation can sustainably remain in that 2 to 3% target band. So this is good news for us. If we go to the next slide, what we see is just the breakdown. I don't know, we seem to be missing some of the detail in that chart, but basically it shows you the breakdown of headline inflation. So all the different things that drive inflation quarter to quarter. And the two colours I'd like you to focus on in that chart are the yellow bars, or the yellow components, and the red components. The yellow components, effectively the cost of building a house, and the red components are what we call market services inflation. So these are not services for things that are, I guess, set by governments. So perhaps public transport fares, but things that are set by the market. And you can see over the last couple of years that both the yellow and the red components have been sort of the problem children of inflation. And just in the last couple of quarters, both of those series have started to behave a little bit better. And this is, effectively the story that's giving us a bit more confidence in the inflation outlook. I think just finally for the last slide, if we can just flick to that, what this all means is, we have a world where clearly the global backdrop is more challenging. We have a domestic story where we are a bit worried about the lasting impact of pressure on margins. And, we do feel that does inject some asymmetry into the outlook for the labour market. And what I mean by that is, we're more worried that the unemployment rate might go up than down. And the other thing that's happened in Australia this year is that the consumer has slowed a lot in the first 4 months of the year. And that was a bit unexpected for us. And so that has forced us, and like the consensus of economists, to make some further downward revisions to our growth forecast for Australia. So if you have a look at that chart on the right, basically it shows you how expectations for growth this year in Australia have changed. They got cut in April with Liberation Day and the news around all those tariffs, and they've been cut again, basically on the back of evidence that shows us that the consumer was a bit softer for the first 3 or 4 months of the year. The chart on the left shows the real cash rate in Australia. So this is just a measure of the RBA's policy rate adjusted for inflation. And if we just ignore that period around COVID, where the chart gets a bit distorted because that series is very, very negative, what we observe is that real cash rate is well above 1% at the moment. And you can see historically, like, we look at that period after the financial crisis, so say from 2010 onwards, a real cash rate above 1 is actually quite high. And so what this tells us is that the Reserve Bank, I think, has scope to cut rates over the coming months, the next couple of months, to get that real cash rate back to a level that's more consistent with a neutral stance of monetary policy. And so this is why we have at NAB a forecast that they're going to cut in July at the next meeting. They'll cut at the meeting after that in November, and then they'll wait, in August, and then they'll wait a couple of months and cut, we think, one more time before the end of the year in November. So on our forecast, another 75 basis points of rate cuts coming. That will take that real cash rate back to around that 50 basis point level, which to me feels much more reasonable and much more appropriate for an economy where we're a little bit worried about a modest rise in the unemployment rate and a little bit worried about how the consumer is holding up. So that's good news in the sense that we know that the economy is sensitive to the level of interest rates. We know that as rates continue to come down and we get at least 100 basis points or a bit more of cuts into the system, that will start to put a floor under growth. And there are even signs already in some of the high frequency indicators around housing. And interestingly, also in our own internal spending numbers that we see within the bank for the month of May. And so there are signs already that the rate cuts, I think, are perhaps starting to take effect. So while this year feels like it's going to be another year of sub-trend growth, it'll be better than 24. I think what it tells us is that we are on a trajectory to better growth outcomes, and that by the time we get to the end of this year and start 2026, we feel like the economy should be back on a path to trend growth or possibly a bit better. So I'll conclude there and then hand over to John and look forward to taking any questions you might have later in our webinar. Thanks, John.
Thank you, Sally. Good to see you. I wanted to run through a couple of things today, and It's just some new information that has come out, and I think both areas have got some significance for the sector. One is the annual list we do for the AFR of the largest givers in Australia and where that's heading and what it's telling us. And the second one, I think even more significantly, is the ACNC have just released their latest set of data for all of the financial data that they collect for the sector. So I'm going to take a bit of a long-term view as to where that's headed and, again, what that's telling us and perhaps some lessons for the future and a couple of scary bits in there as well. So if we can go over to the first one, thanks, Kat. I'll start with the AFR list, and you can see some highlights here. We started doing the list back in 2016, so this is the 9th year that came out of that. So we've got a good length of time to analyse what's going on there. And it is one of the more interesting parts of my role, I've got to say, although it's all interesting. I love numbers and data, but there are some clear trends emerging there. Now, you can see some of the highlights here we'll go through. It was a total of 1.37 billion over the 1 year there for the 1 year of giving, and that was up 10% on the previous year. There are some very large givers in that now, and we had 4, as you can see in the dot points there, over 100 million and 25. So half of the list gave 10 million or more in the year. And I think one other interesting point is if we just look at the top 3, they had a huge amount of money sitting behind them. So that money will provide giving for them over many years to come, and depending on how markets move, will grow as well. So almost $12 billion sitting just with that top 3 philanthropists in their corpus. There is a very discernible growing voice of women in the list, and we get a bit of a say as to what the main story is. And there's a group called She Gives, which we've been a part of, trying to promote more women interest in the area and giving. And there's a good story around that on it. But if we look at the data, we find there are double the number of purely female-led philanthropists among the 50 compared to male. Now, the list is really dominated by families where it's both in a traditional shaped family doing it. But in terms of lone women or groups of women versus men, they're winning on that as well. So that's quite significant, I think. And the final one that I will highlight there is the importance of bequests and inheritance and how I think that's going to continue to move forward. So next one, thanks, Kat. So if we look there, this is just a nice, easy way of looking at that top 50 since we started it, so over the 9 years. We can see there, obviously, the top line is the biggest number. The bottom line is where the 50th giver was. And each of those lines has moved up fairly consistently over that period. But I guess the way to really look at where it's gone is the middle line, which is just the average giving of the whole 50 together. And that's tripled over that 9 years, which is fairly astonishing. So very strong growth amongst that 50. And I think one of my other big observations is the causes that they've supported. So we've continued to see that widening. And I've often said at the start of the list, it was pretty much universities, arts and medical research, but we're now seeing quite a few other causes come in, and the donors are really looking at what society's largest issues are. So we're seeing environment growing, and that's a very solid 4th, as you might expect. We're seeing things like social housing growing fairly strongly, and I've commented a few times about one of the 50 who gives about 30 million a year away is just focusing on trying to improve the way government or new government people who are coming in are better trained to look at society's biggest problems. So it's not a left versus right thing. It's really trying to equip our politicians better with training. So certainly a widening of the causes, and I think starting to address more those big problems that we see. So the next slide really talks a little bit about this inheritance bequest issue. So all the dots on there are the top 50 from the list that came out only a couple of weeks ago. And you'll find all of that on the JBWeir website, by the way, as well, if you want to go into detail. But I've broken up the 50 here into the yellow dots are where the founder has passed. So either quite a few years ago and set up a foundation that's still running, or perhaps has passed during the year and left a large amount to a particular or a group of charities. Predominantly, it's the former of those. So out of that 50, 22 of them are for people who set something up in their lifetime and now aren't with us anymore. And that says two things to me. It says, one, it's a really, and I think, growing important part of this list. But two, there are a lot more opportunities for black dots on that chart there of living people with wealth who perhaps haven't joined the joy of giving as yet. So I think there are two strong opportunities in that. Now, just to talk about where this might likely go, if we move over onto the next slide, this one, and you will have seen some of this when we talked about our bequest report fairly recently in one of our other webinars, but I thought it timely just to throw up this chart again of the expected number of people who are going to pass each year in Australia. And we can see we're just on the precipice of that increasing dramatically. And the reason I put this up again now is to link it to that list of the major givers and the proportion of people who have passed. So we are seeing there, if we look at the wealth lists, we can look at the age of the people on the wealth list, and a lot of them aren't particularly spring chickens anymore. And I think we're going to continue to see that high-level givers coming from people who have passed, adding to their existing foundations or establishing new ones within that, and or the inheritors of part of their wealth starting to do things different to what their parents done, and perhaps increasing their rate of giving, and certainly looking at changing cause areas as well. So I think those two are very intricately linked, and we are going to see some significant and growing changes on this. And for those of you who are looking at this, one of the lines I like to mention is it's about offering legacy rather than talking about mortality. So that opportunity, and I think that conversation is going to increase. So the next slide is something that you might not have seen as yet. Very recently, only in the last week or so, the Treasury has put out a consultation paper on private ancillary funds. And it follows the Productivity Commission, which had a big inquiry that we've spoken about into philanthropy during 2024. They released a number of recommendations for changes there. Not many have come through, but we did have an election and that sort of got in the way of things a bit. But one of them was to look at what the name, but also the payout ratio should be for private ancillary funds. So the Treasury consultation paper is asking for views on that, and I think it'll be interesting to see what comes out of that. The comments are due by the 1st of August, so you've got a few months. What they're proposing or thinking of is increasing the rate from, at the moment, 4% for public ancillary funds or sub-funds, 5% for private ancillary funds, they're the current rates, but increasing those to somewhere in the range of 5 to 8%, and also allowing a smoothing of distributions over 3 years. So if you want to fund something and give 20% to that, you can do that in whatever breakup you'd like over those 3 years. So you don't have to give the one rate each year. So I think it's really interesting that they're looking at this. I, being a long-time analyst of it, can see the both sides of the argument. I think obviously getting more money to DGR ones earlier would be a wonderful thing, but I wouldn't like to discourage people who haven't yet set up PAFs. We have currently 2,500 PAFs in Australia and about 1,500 public ancillary funds, giving $800 million a year from the PAFs alone away, and about half of that from the public ancillary funds. If a change to 8% was made straight away, I fear it might discourage some who were going to set them up. Don't really know the exact numbers, but the 150 odd per year that are set up, some will say that that's a bit too high if we want to run this thing into perpetuity. So I think there's a balance of that versus the very real need for DGR ones to get more of the money and earlier. So it'll be a very interesting debate. If we already had 50,000 private ancillary funds compared to the 2,500, I think it's almost a no-brainer, but whether the timing's right. So let's see what the consultations bring up, but I think there is a balance to be had there. So over onto the ACNC's data. So ACNC started collecting financial data from charities in 2015. Before that, we didn't really have a total view of what the sector looked like. We had estimates. The ABS used to do a survey every 7 years. But since then, we've had annual data, which is fantastic. And we can now start to see some pretty strong trends. So I'm going to run you through the trends for income, expenses, and then assets, and then do a bit of a commentary on them. So for income, you can see, you look at this chart and you think, well, that looks pretty good. We've had quite a strong level of income growth over those years, and we've had all of the other lines going up. So that's good. However, the orange line, which is the government dollars that are coming to the sector, have grown from 40% in 2015 to almost 50% this year. And indeed, if we go further back before 2015, it used to be 30. So we've talked before about that reliance on government money is a little bit of a risk for the sector. And as Sally has highlighted, the pulls on government budgets are tighter as defence spending potentially grows and other things. And so that 50% is probably not going to go to 60 or 70. So although income growth has been good, the reliance of where it's coming from is a little bit of a risk. Now, the very astute amongst you might be looking at the yellow line and saying, well, that got a good kick up there in 23. And indeed it did. Philanthropy going to the sector, so donations into the sector grew to 18.8 billion, which was up around $5 billion. Not unfortunately, but one of the main reasons for that was Minderoo had a very large, that's Andrew and Nicola Forrest Foundation, had a very large $5 billion, 4.9, donation into it in that year, which pretty much totally accounted for the increase. So that yellow line jump up's not perhaps as exciting as you might think. It was going into their foundation. So income growth, pretty strong. If we move over to the next slide, and we look at where the money goes, expenses. And again, expenses going up is never a good thing, but it's actually going up faster than income. And you can see the big kick up there in 2023 as well. So expenses have risen faster than income, and employee part costs of those expenses has remained very consistently at 55% of that total all the way through. So there's not been a change in that. The mix has stayed identical, and that is a little bit of a, I guess, not concern, but it does offer opportunities for rethinking how certain sectors might operate. The for-profit sector has about 25% of its expenses as employee costs. Now, there are a whole lot of differences, and the for-purpose sector is very much more people-focused and centric sector, and so there is a need for a higher employee cost. But when it remains at 55% for that period of time, and even before that, there are clearly opportunities for thinking about how we do things. So expenses went up faster than income, and obviously when you put the two together in the next chart, you can see that that's not a good thing. So this is the charity sector margin. So it's just taking the top line income and the top line expense, putting them together. And when I look at that chart, I get a bit sad because those lines are very close. So it says that there's not much margin in the sector. And in fact, in percentage terms, the margin has decreased over that period. So even though the two lines have gone up, the gap hasn't changed at all. And so the percentage margins got worse. And that tightness and getting tighter is really the biggest problem for the sector. The for-profit sector has better margins than that. And as I've said many times and will continue to say, it's because we don't value the social return or the impact that we produce. We just get reimbursed for the costs that we have. And that's not the way in the for-profit sector. So that is a need to change. We can't continue with that sort of margin going out and expect to grow incomes. Now, The one bit of good news, if we go on to the last chart from me, is when we look at the sector's balance sheet. So I'll pop over to the next one. Thanks, Kat. Oh, thank you. No, sorry, go back. I went too quick. So this is the assets of the sector. So all of those earlier ones were just dealing with the P&L, so the income, the expenses, and then the margins. This is the assets. And you can see from that total assets and then net assets in the orange have increased. They're very strong. Liabilities are relatively low and have remained pretty low. So there are opportunities, I guess, for not just thinking about the P&L, which remains very tight, but thinking about what the assets are within the sector, which remain very strong. So with balance sheets strong, tightening margins, potential peaking in government income as a percentage of total income, there are opportunities to rethink how we use these balance sheets. First question should always be, is your balance sheet, your assets, contributing in the way that your P&L is? Everyone obviously thinks very closely about where they can get their income, what they spend it on, and measures that against impact. Do we do the same with what our assets are? So is there an opportunity to rethink what are very strong balance sheets, and is that really matching your impact that you're trying to have? Is there replication across the sector? So this is the total sector assets. Obviously, each organisation and each sector will be different, but is there a replication of assets between charities? So, each one has got the same thing. Is there sharing of those sorts of things? What's the utilisation rate of the assets that you've got? Do we only use it 3 days a week? It's a great asset, but we don't overutilise it the way that perhaps the for-profit sector does. Are they the right assets still? Or have we just got legacy assets that are sitting there? How often do we analyse that? So overall, I think, is there an opportunity for a rethinking of the sector's broader strategies and combining that tight margin but the very attractive balance sheet perhaps that the sector's got? We did a report called the Cause Report that a number of you might remember. In 2016, we're going to redo that next year. So, what does the sector look like post-COVID? What does it look 10 years on? And we'll be going into a lot of those areas in a lot more detail and by sector as well. So I think some real opportunities for some bigger picture thinking coming. I'm going to stop at that and pass back to Jacinta. Thank you.
Excellent, John. Well, thank you very much to yourself and Sally. Sally, great insights on the current market dynamics and anticipated improvements to trend growth. And John, fantastic insights into the large-scale giving and many other aspects too. So we will now go to Q&A, and we've got some really great questions that have already come through. So Sally, I might start with you. What are the implications surrounding your forecast of growth versus declining productivity in the economy?
Yeah, it's a great question. So I guess the productivity story, we tend to think of as a bit of a long run story. And the challenge there is that, yes, our productivity performance has been poor in Australia, but so has everyone else's. And so what that tells us is that while there might be some things around this issue that are quite specific or unique to Australia, it also tells us that this is part of a trend in Western economies as well. So it's good that productivity is on the government's agenda. That's a positive thing because we know productivity reform is hard. There isn't really much in the way of low-hanging fruit for governments to do, and so it does mean that anything that you try to do to lift productivity usually involves some sort of meaningful reform, and it feels in the current environment that reform of any nature is quite difficult for politicians to prosecute. So hopefully, this being a 2-term government, most likely a 3-term government, they do have the runway to consider some meaningful policy change because we do know that over the long run, productivity growth is the only lever that we have to pull to lift our standard of living. And so when we think of, I guess, that distinction between short-run growth forecasts, which are probably much more reflective of the genuine economic cycle and long run forecasts. Productivity growth is less important for the short run, but super, super important for the long run. And so when we think about, what might trend growth be in Australia, really the only way that we can lift that is either to lift our labour supply, so that either we can do that through higher participation in the labour force, or we can do it through higher population growth, or some combination of both, or productivity growth. And so it's really critical for our long run outlook. So we should care about it because it'll matter for our children in the next generation.
Absolutely. Thank you, Sally. And John, I'll go to you next. Really good question that you raised around leveraging assets. Where do you think the for-purpose sector should start in terms of thinking about this?
It's a good question. I think the sector, each group, each charity within the sector knows very much what they do, but I think there's often not a lot of cross-pollination of ideas, getting together, mergers, very few that we see of that, sharing of assets, those sorts of things. So I think a bit better view of what's going on in the broader sector, your sector, and just wider use of the bigger picture view out there. So we don't get enough of what's the overall sector doing, who are my not competitors, because I don't think we are competitors within the sector between cause areas, but what opportunities are there for that? So I think that's the first and biggest thing, just what is that state of play within the sector? It strikes me as really odd that we've got such strong balance sheets and such weak margins. That doesn't make sense.
Yeah, good call. Thank you for that. Sally, given the announcement of consideration of further tax reform, do you think it will be good for productivity or just an opportunity for more money? What's your view on that?
Yeah, so I think with tax reform, the way we need to think about that is not to do little marginal changes. So when we look at, I guess, what the government has proposed around some of the changes to super and the taxation of unrealised gains, one, it doesn't raise a lot of money, and two, it's very marginal in the scheme of things. And so when we think of tax reform, we need to look right across the taxation system, not just at particular bits and pieces, and take a very holistic view in terms of how we want to reform that system. But absolutely, that's a really critical piece of the productivity reform puzzle, I would have thought. And so while the Prime Minister has said, we're not going to do wholesale tax reform in this term of government, I guess we can maybe hold out hope that that's something they address should they win another term. But I think if we don't seriously consider wholesale tax reform, then really we're just putting an unnecessary sort of constraint or handbrake on what we might achieve on the productivity front. So I would argue that's a really critical piece of any productivity agenda.
Right. Sally, we might stay with you. What is your opinion of the single greatest risk to our economy in Australia today?
I think the single greatest risk is probably just complacency. We've been an economy that really over the last 30 decades and out of that last regime did very, very well. And that was a consequence of, I think, good luck, but also some good management, around fiscal settings where when, we did face meaningful global challenges like the pandemic and also the financial crisis, governments had the ability to really support the economy because they'd done the hard yards and been reasonably prudent in prior years. We seem to have lost that impetus a little bit. So I don't think that's good, because we know that global challenges come. Like, we don't know when they're going to come or what form they take, but they will come. And so I think there's a sense that, we've had a really good run. And like I said, that's been partly good luck, partly good management. And I'm not sure that that's sort of enough in this new regime, where I think we as a country have to be far more proactive, far more forward thinking, and really make sure that we have the basics right. So, for example, energy policy is so critical to get right for households and for businesses, and that's something you'd argue that we haven't done a particularly good job of. So I just sort of think that, a sense of complacency around, being able to rest on our laurels is probably the biggest risk to our country, because, you know, in pretty much everyone else's eyes, we have so much going for us. We've got good population growth, so good demographics. We've got a country that's abundant with energy, with natural resources, and they're all the things that, you know, people are going to want more of and more security over, and we're in a good bargaining position when it comes to all that sort of stuff. So there's a lot to like about Australia, and I think in some respects we're possibly our own worst enemy when we think about, you know, what might go wrong over the next decade or so.
Thanks, Ali. Yeah, really interesting. John, I'll go back to you around the expenditure increases for charitable organisations. Is it largely around fundraising, admin costs? What else are you seeing in your data?
Look, with employee costs 55% of the total, you've got to still look at how that's being used. And you know, it is a more people-centric business overall, the sectors, but are we taking the opportunity to be as innovative as perhaps a lot of other groups in the for-profit space are? So it's just doing things smarter, I guess. The other thing is, if you want to improve margins, you've got to either increase income or reduce costs. So it's a little bit of both. And if we're saying one of the major income areas in terms of government percentage-wise might not grow, then what other income opportunities are there? And you know, we've talked last time a little bit about impact investing and charities trying to get paid for the impact that they do rather than the reimbursed bit. So the focus on what sort of projects might be there. And we are seeing growth in certain areas of philanthropy. And you know, to link back to Sally's comment about taxes and such, you know, as a wealth manager, we're not necessarily a proponent of inheritance taxes, but most other countries have got them, and we've got a lot more people passing away in the next few years. So if that were ever to happen, the sector needs to be prepared for that, because that would be a massive positive for income. But you've got to be prepared as well.
Thank you. Great insight there. Just on that trend of impact investing and philanthropy, how do you see the intersection of the two playing out in the sector?
Yeah, look, I think it was hinted at a little bit when I mentioned that the assets sitting with just the top 3 philanthropists were massive. And in fact, that total there, if I flick back through my notes, was what, $12 billion. So that's just sitting with 3 donors. You know, if you add all of the other philanthropists together, you're getting probably closer to 50 billion. That's all the different forms together. If you're adding in individuals and families and perhaps some businesses with financial assets that want to do good with those assets as well, the potential is massive for people investing those funds that way. The blockage has been the, I guess, number of quality projects that are out there and people being prepared to put a due diligence on. So firms like ours looking at them and saying, you know, we've run the numbers over this. We think this is a good investment in terms of the risk versus reward profile, all that sort of thing that we do with the listed shares. And that's starting to change. JB Weir now has an area that's devoted to analysing those sorts of things. And you know, other firms are starting to move towards that as well, slowly, admittedly. So I think the things are in place, and we have seen a lot more assets devoted to that, but the opportunity is certainly huge. And I think charities, who should be the originator of a lot of these projects, are slowly getting their minds towards that. But I think it'll be a need rather than a nice to have as time goes on.
Thanks, John. We might stay with you. You seem to be very popular in the Q&A. Question around income growth across the whole sector. Are you seeing that in specific areas or across the whole area in total?
Look, we haven't gone into the deep analysis yet, so I won't give you a full answer, but I've got to say that the strongest area has probably been into the philanthropist area. So don't forget, private ancillary funds, charitable trusts, all of those are charities in their own right. So that the fastest growing area is people putting money into those vehicles and then distributing it around to, you know, international aid, welfare, arts, whatever it might be, health. So it's the fastest growing in terms of them. Environment certainly getting some. We participated in a survey that the AGN, or helped them with the survey a little while ago, the Environmental Grant Makers Network. So they're seeing more funds come into charities in those sorts of areas. So I think it's across the board. The only one that's probably has been in decline is religion, and that's only, it lines up with the number of people who tick the census religious box. So, but income to all the others is growing reasonably well. But yeah, giving vehicles and philanthropy is probably been the fastest growing of them.
Excellent. Well, thank you very much, John, and to you, Sally, as well, for your insightful updates, and to everyone who has joined us today. So we are nearing the conclusion of today's webinar. So once the webinar has ended, you will receive a short survey. We would love you to complete it because it will really help us to shape future sessions and content, and it will only take you a minute or so to complete. We will also send out a recording of today's webinar so you can view it once again. To all our customers now and in the future as well, a big thank you for your custom and our relationship. We greatly appreciate it. Should you require any assistance now or in the future, please do not hesitate to let us know. You can find me on LinkedIn, or you can reach out to your designated relationship manager. Thank you in closing. Really appreciate everyone for joining today's webinar, and we look forward to your company at the next one.